Hi everyone, pretty interesting time out there in the market at the moment. A lot of noise and market sentiment up, down, week in, week out, depending upon which article you read. So I thought it a pretty timely opportunity to really highlight to people still some amazing opportunities that sit in the investment real estate market. For those investors out there who understand that real estate is a long-term game to give you the benefits to free yourself financially later on in life and help you get better taxation benefits and all sorts of things in the interim, this is definitely still the right time to be looking at real estate. We don't give up. We can hang up the boots and sit idly by and miss growth in the right marketplaces. And that's exactly it. There is no one real estate market here in Australia. We understand what's happening in here in Sydney, a little bit of a clawback on prices. Ultimately, the market ran too hard and too fast, and now we're starting to feel the effects of that. As I said, no one real estate market. We're still getting some fantastic gains in other pockets of the country where there's better forecasts for stronger rental growth. Current rental returns are fantastic compared to the likes of Sydney, and the forecast for property value growth is really making sense as well. So it's an interesting time. I saw recently Your Investment Property Magazine was talking about the capital growth or yield, and it's often a question we get asked by investors. I want to go and focus on this area because it's going to be giving me a strong rental return. Or I want to go and focus on this area because it's going to be giving me the best opportunity for growth. And really, given the market at the moment, we understand that the full effects of the Australian Prudential Regulatory Authority, APRA, and what's going on at the moment with the Royal Commission, the effects of that have really come into full swing. And lending climate is quite tough at the moment. And so a lot of people are searching for properties that are going to be giving a better return. Better rental return on the property ultimately highlights a stronger ability for us to get a loan on that property as well. It was interesting that magazine was talking about picking one or the other, and I think it's definitely the case now that you really need to be looking and focusing on balanced assets that hit the best of both worlds. A good rental return above the norm and also still showing really good, strong growth prospects for the future as well. There's absolutely no point in going into the middle of nowhere chasing a 10% gross rental return if your property is going to sit completely stagnant in terms of growth and potentially even go backwards. And of course, I'm referencing for the most part a lot of mining towns where people chase rental returns, and it's really not the best thing for your portfolio. So today it's a bit of a detailed video, but I wanted to give you a really good rundown on the concept of growth opportunities combined with cash flow and the world of dual living or dual income properties, which I'm sure you've heard of. The term flies around quite often in the investment industry. If you don't know what it is, this is a really good video for you to understand and really learn about how this type of real estate can better you financially and do exactly what we want as investors. So that's what it's all about today, cash flow and growth and the dual living or dual income concept. Now, for those of you who don't understand what that is, it simply refers to a house and land contract or a two-part contract investment opportunity where we purchase a parcel of land and enter a contract into a subsequent build with a builder for that particular parcel of land. Two contracts with two individual parties married together to give us that term house and land or home and land package. Very, very simple process. The industry's come a long way in the last few years to really help perfect that process. And it's really, really quite streamlined and very easy for investors. I know myself, I've done it several times as an investor, and it's been a really enjoyable process. You just need to work with good groups like us here at Richardson and Wrench Investments and good builders who we've been working with for many years as well. So basically a dual income is, as you can see it here in its rawest, most simple form, is where you construct a single dwelling which actually has two individual properties underneath that one roof. So you can see here on one side, for instance, you'd have a 4-bedroom property, and on the other side, a 2-bedroom property, mirroring that granny flat concept that many people have utilised in the Western Sydney marketplace over the last few years. But obviously this gives us the opportunity to build new, and newer real estate we're seeing in the market now, really getting the better rental returns as well. It's what's referred to as an opportunity to ultimately get the highest and best use out of your piece of land in regards to rental returns. So what it basically refers to is two income streams with the one property, two properties under the one roof. And in terms of a typical kind of design, if you take a look on your screen now, you'll see a typical floor plan where on one side we've got a 4-bedroom, 2-bathroom, 1 lock-up garage property, and attached on the other side with a communal wall is a 2-bedroom, 1-bathroom, 1 lock-up garage property. You can see there how it mirrors that granny flat design, and we've got 2 fully separate entrances, 2 fully separate fenced backyards, 2 fully separate lock-up garages. So individual leases to be managed. That's where we can get really boosted rental returns. I'm talking 6+% gross rental returns, and in good marketplaces. So we don't have to chase 10% returns and go backwards in growth, and we definitely don't have to stick to core growth markets getting 3.5% gross rental returns like here in Sydney, for instance. We can get it right and diversify elsewhere. So going into some detail about a particular opportunity, I really wanted to number crunch and show you guys out there exactly what a dual living property can do in terms of the actual financial gain. And that's what we're all here for. How is this property going to make me money? Where and how, and what does that actually mean for me in the future of my investment portfolio? And that's what's key with dual living as well. So I just wanted to take a typical package. We work on dual living packages in a couple of pockets of the country, ranging from mid-5s all the way up to $800,000, depending upon the area and the size of the land and what have you. And generally speaking, they float around that 6% gross rental return, which when done right is really, really offering some good positive cash flow opportunities. So this instance, I wanted to talk about a bit of an entry-level one. This package is in an inland location, just short drive out of Newcastle, which is a fantastic market that's been performing really well for our clients, and the future looks really bright there. Industry's growing. It's one of our largest areas, actually our 6th largest region when you combine the Hunter, the Newcastle and Lake Macquarie as well. So really impressive. It's full-blown own economy. So I thought it was a good one to discuss. So just for those sticklers out there who often like to comment about cash flows and what were the particulars involved, I thought I'd lay them all out here for you. So it's a $561,000 package. That's the land plus the subsequent build of a 4-bedroom plus 2-bedroom property. In regards to taxation implications in this cash flow scenario, we're entered into a $100,000 income, so the buyer is subject to a 37% tax bracket. 4.5% interest only rate was used, which today, late 2018, is an interest rate that we're able to get with a range of banks. And we've done a 10% cash deposit and also cash on the stamp duty and the lender's mortgage insurance. So when we're talking about 90% loan to value ratios, borrowing 90% of the package price and putting in 10% ourselves, we have the implications of lender's mortgage insurance, which is a couple of $1,000s in this instance. The beauty of this, I remind you as well, is when we talk about house and land packages, really good thing is some cash saving for the investor up front is the fact that we're only paying stamp duty on the land component, which in this instance is really quite low. We're talking about $4,000 or $5,000 of stamp duty. So some good savings up front there as well. And $700 per week rent, and that's taking the lower end of 3 rental appraisals from local agents there as well. So no smoke and mirrors and BS here, real data from the local agents. What it also includes to affect the net rental return is the rates payable for the council, the property management fees associated, insurances on the home and landlord insurance, 1 week vacancy taken into consideration per annum, solicitor fees, and then also the depreciation of actually attained depreciation schedules on this. So we're getting pretty accurate data here as well. Now the exciting part to talk about the numbers. And ultimately for people who understand what real estate does for us, it's not a short-term thing. Sadly, a lot of people still have that in mind, and it's really not the idea of investing and over time accumulating a few properties and diversifying and doing it right. It's a long-term game. Most real estate today is really taking upwards of 13, 14 years for that property doubling cycle to come into play. We're looking at a 6% growth per annum average around the combined capitals of Australia. So it's a long-term game, and for real estate to really do the right things, that's what we need to give it. So using just a conservative 5% per annum growth rate on this property, the market value in year 10 is an awesome $950,000. The gross rental yield is 6.1% with a net rental yield of 5.1%. So some really good, strong on paper numbers which could help the serviceability for our next properties into the future with the banks as well. The actual year one after tax cash flows, that's taken into consideration a little bit of money that you've got back from the government after using depreciation on this property as well. We're talking about a huge positive cash flow amount of nearly $9,000 on there as well. So that's a huge amount of money to be getting back from this asset, which as investors we should be putting back towards the property, either paying down a chunk of the debt, or what the smart thing to do if you can do it is offset with using an offset facility with the bank, chuck it into the offset account, build up that offset account so it reduces the loan amount and the interest amount payable, but we still have access to that cash should we need it for any other diversification at all as well. But something that's really cool is the equity available in this asset at as little as year 3 of owning it is, and based on a 90% loan to value ratio, is $82,500. So that puts us in position as investors to now in year 3 draw that amount of money out, take a line of credit and go and actually do another deal. And it's this kind of real estate which is absolutely pinnacle for investors to understand and get involved with, because what we want to do is in 5 or 10 years, however long it may take or however long we can do it in, accumulate a number of well-placed and well thought out diversified properties. And this is one property that can really boost the opportunity for people to recycle equity and quickly move on to the next deal. There's realistically no better thing in the market to help and assist in this market right now as well. So in conjunction with helping us get the loan, helping us service future properties, it's really helping us boost and get that equity out to move on to the next property. So you can see it's really doing, as an investor, exactly what we wanted to do. And the depreciation on these properties is great. We've got 2 kitchens, 3 bathrooms, it's a big property as well, roughly 250 square meters of total build. So depreciation is really quite strong. So as you can imagine, what we want to do is reduce debt, either by actually paying down the debt or utilizing that offset facility. And it's all really about the amortization of the loan. So you can see here, debt and time, where we want to end up. The key point, let's say you're 40 years old, you might be able to realistically offset or pay down this property. If you're good at saving and you're good at putting the cash flow back that you've earned from the property directly into this property, you can be talking about having this property paid off or fully offset in as little as 15 years. So if you're 35 years old, by the time you're 50, you might be able to have this property fully offset, paying you circa $40,000 a year pure cash flow, and then also it should at that point in time be worth nearly double too. So now have a think, if you over the next 3 to 5 years accumulated 2 of these properties into your portfolio, by year 15, year 20, when it's nearly paid down, the cash flow would actually be able to sustain you living and without working a full-time job, which is exactly what so many investors out there dream of. And this is the type of real estate that can do it. Not only would it be paying you a passive income, that means you potentially don't have to work, but you might be looking with 2 properties north of $2 million worth of unencumbered real estate. That's your retirement living right there should you decide to sell those properties as well. So some really, really cool things to understand when you look at and boil down the numbers of what, property in general, the ideology around getting multiple properties, own over many years to pay them down, get passive income streams from them, get tax depreciation benefits from them, and then accrue a really, really healthy market value after years of ownership. Just the sheer numbers that are involved are good to understand where and how it can perform for you. So dual living is a really, really good way to sort of, accelerate your investment earnings and accelerate paying down and the amortization of the loan on your investment property to get the best result out of our portfolio. It's timely type of real estate given how hard lending is at the moment, and it's definitely something we've had really good results for our clients in a range of marketplaces as well. So I heavily encourage you to register your interest, even if it's just to catch up for a coffee and understand about what we do at Richardson and Wrench Projects, where you're at, and how investment or real estate could better you. I have conversations with people year in, year out who are constantly saying, oh, I'll do it soon, I'll do it soon, I'll do it soon. And the land values are going up, build costs are increasing, and they're no better off in terms of living the financially best life that they can. There's no better time than the present, and there's definitely no one real estate market in Australia. So if you want to learn a little bit more, register your interest. We can talk about a dual living deal and catch up and see if we can get you into something as soon as possible. Thank you. Speak to you soon.